The American dream isn't dying, it's already dead. And the autopsy reveals something far more sinister than a simple market crash. What we're witnessing in 2025 isn't a housing bubble ready to pop. It's a systematic dismantling of the middle class, orchestrated through decades of policy failure, monetary manipulation, and corporate predation. The affordability crisis gripping this nation right now makes 2008 look like a minor correction. Back then, prices collapsed. Today, they're weaponized. Back then, people lost homes to foreclosure. Today, an entire generation is locked out before they can even make an offer. Here's what they're not telling you. In 2024, the median home price hit $420,000, an all-time high. According to Harvard's Joint Center for Housing Studies, that's a shocking 5 times the median household income. Real wages stayed flat for the 5th consecutive year. In over 99% of U.S. counties, the average home is now officially classified as unaffordable for the median worker. The National Association of Home Builders confirms that nearly 75% of U.S. households cannot afford a median-priced home. Read that again. 3 out of 4 American families are priced out completely. In 1985, the typical first-time buyer needed just 5 years to save a 20% down payment. Today, according to Realtor.com data, that number has exploded to 13.5 years. That's the longest timeline ever recorded in American history. The average mortgage payment has jumped 113% since 2020 alone. That's the fastest affordability collapse this country has ever seen. And it's not slowing down, it's accelerating. Institutional investors like BlackRock and Invitation Homes have spent over $60 billion quietly vacuuming up single-family homes that the public never even saw listed. In the first quarter of 2025 alone, investors bought 27% of all U.S. home sales, the highest percentage in over 5 years. Boomers are sitting on roughly $12 trillion in home equity, most of it locked behind sub-3% mortgages they're never giving up. Meanwhile, for the first time in U.S. history, the majority of adults under 40 believe they will never own a home. This isn't a housing bubble. This is a financial chokehold. And in this breakdown, we're exposing exactly how it happened, who's to blame, and why 2025 is worse than 2008 in every way that matters. Subscribe to Housing Intel right now for data-driven real estate intelligence that cuts through the noise and reveals what Wall Street doesn't want you to see. For over a century, the path to prosperity was simple. Work hard, save money, buy a home, build equity, pass wealth to your kids. That formula built the middle class. But in 1913, the federal government created a central bank with the power to print money at will. That single decision lit a fuse that's been burning ever since. And in 2025, that bomb has finally detonated. When the government broke the final link to gold in 1971, it opened Pandora's box. Suddenly, there was no restraint on money creation, no anchor to reality, just unlimited printing whenever politicians needed to fund programs they couldn't afford, or bail out banks too big to fail. After the dot-com bubble burst, they printed. After the 2008 financial crisis, they printed massively. After COVID hit, they went absolutely nuclear with money creation. Here's the brutal physics of inflation. When you print trillions of dollars, that new money doesn't create new value. It dilutes the value of every existing dollar. Prices rise across the board. If you're holding cash, you're getting destroyed. If you own assets, you're protected. The top 10% of Americans own 93% of all assets. Everyone else is drowning in an invisible tax they never voted for and can't escape. Housing became the default inflation hedge because it's the one asset ordinary people understand intuitively. You can live in it. raise kids in it, fix it up. But here's the trap. When money printing drives home prices to the moon, and you don't already own a home, you're locked out of the only inflation-resistant asset you could actually use. According to Federal Reserve data, boomers locked in mortgage rates below 3% during the unprecedented era of cheap money. They refinanced, multiplied their wealth through appreciation, and now sit on equity that would take the average millennial over a decade just to save for a down payment. Younger generations face 7% plus interest rates on homes that cost double what boomers paid, while earning wages that have been stagnant for 4 decades. That's not a market. That's a rigged game. And the house always wins. The housing shortage didn't happen by accident. It was engineered through decades of deliberate policy decisions made by people protecting their own property values at the expense of everyone else's future. Home building has collapsed 39% since the 1970s, even though America added over 130 million people. The U.S. is now short an estimated 3.2 million homes, and that deficit grows every single year. Private equity firms now own 1 in every 6 single-family homes in many major cities. In some Sunbelt markets, that number climbs even higher. Due to 15 years of near-zero interest rates, older Americans who already owned homes locked in historically low rates and multiplied their wealth through inflation-driven appreciation. Meanwhile, young people got priced out entirely. According to Redfin's latest data, active listings are up only 5.1% year over year, the smallest increase in nearly 2 years. That's not recovery. That's stagnation in the face of explosive demand. Here's what happened. Once homeowners realized their houses weren't just shelter, they were wealth storage devices. They started voting for anything that would drive property values higher. Zoning restrictions, density limits, endless permit processes, neighborhood opposition to new construction. None of it was malicious. It was pure self-interest. When supply is choked, prices rise. For existing owners, that's fantastic. For the next generation, it's a financial death sentence. In the 1970s and 80s, your parents bought homes for roughly 2 to 3 times their annual income. Today, it's double that for most young people. In 1985, it took 5 years to save a down payment. Today, it takes 13.5. And because so much of the country's housing inventory is now trapped behind ultra-low mortgages that owners refuse to give up, new buyers are forced to compete for a shrinking pool of available homes while facing interest rates that have more than doubled. Houston offers a stark contrast. By allowing builders to build and letting the free market operate without strangling zoning laws, home prices there have remained remarkably stable even as the rest of the country exploded. That's not luck. That's proof that when you let supply meet demand, affordability stays intact. But most cities chose the opposite path. They chose scarcity. And now they're reaping the consequences. Real wages have been flat for roughly 40 years. That's not hyperbole. That's documented economic reality. Globalization allowed corporations to offshore manufacturing, suppress labor costs, and maximize profits, while workers saw their purchasing power evaporate. The gap between productivity and compensation, once tightly linked, has become a chasm. According to data from Realtor.com and Harvard's housing studies, if wages had kept pace with home price inflation, the average household income today would need to be over $116,000. Instead, it sits at $70,000. That's a gap of $46,000. That's the difference between home ownership and permanent renting for millions of families. In 1975, a couple earning median income could afford the median home with relative ease. By 2025, that same couple would need to spend over 40% of their income just on housing costs. That's officially cost-burdened by federal standards. Harvard's 2025 housing report highlights a record-high number of cost-burdened renters and a staggering increase in cost-burdened homeowners. People aren't lazy. They're not irresponsible. They're playing by the rules in an economy where the rules have been rewritten against them. The formula that built the middle class, get a job, buy a house, build equity, didn't just stop working. It was systematically dismantled. And here's the cruel irony. While wages stagnated, money printing made assets skyrocket. If you already owned property or stocks or Bitcoin, you got richer. If you were still trying to save enough for a down payment, inflation ate your savings faster than you could accumulate them. The system became a wealth extraction machine, siphoning resources from workers to asset owners. And because homes are the largest asset most families will ever own, being locked out of home ownership means being locked out of wealth creation entirely. This isn't just about housing. It's about the survival of the middle class itself. And right now, the middle class is losing. Wall Street looked at single-family homes and saw dollar signs. Not neighborhoods, not communities, not families raising kids and building memories, just yield, just returns, just another asset class to financialize and extract value from. Institutional investors entered the market with billions in capital, armed with algorithms that could evaluate and bid on homes faster than any human family. They weren't buying a few houses here and there. They were buying entire neighborhoods. Firms like BlackRock, Invitation Homes, and American Homes for Rent have spent over $60 billion acquiring single-family properties across the U.S. In the first quarter of 2025, investors accounted for 27% of all home purchases nationwide. That's over 265,000 homes in just 3 months. The math for these firms is brutally simple. Inflation drives rents up. Asset prices appreciate over time. Leverage is cheap when interest rates are low. And because all the scarcity-promoting regulations guarantee limited supply, long-term appreciation is essentially guaranteed. Everything that makes the housing market hellish for young families makes it a goldmine for institutional buyers. They're not hurt by high prices. They're fueled by them. They can pay cash. They can close in days. They can absorb temporary losses that would bankrupt a normal family. And once they own a property, it's removed from the ownership pool forever. It becomes a rental, a revenue stream, a line item on a balance sheet. By the time most Americans realized what was happening, Wall Street had already entrenched itself. According to recent analyses, institutional ownership now represents roughly 20% of all single-family residences in the U.S. The majority are still owned by smaller mom-and-pop investors, but the big players owning over 1,000 homes each control enough volume to influence entire markets. They set rental rates. They determine which neighborhoods are worth buying. And they have access to data, capital, and speed that no individual family can match. The result is a market where young families aren't just competing with each other. They're competing with trillion-dollar balance sheets. And they're losing badly. Mortgage rates spent over a decade near historic lows. From 2010 through 2021, rates hovered between 2.5 and 4%. Homeowners who bought or refinanced during that window locked in payments that will never be matched again in their lifetimes. Those ultra-low rates created a golden age for existing homeowners. Equity soared. Monthly payments stayed manageable. And refinancing became a wealth multiplication tool. But for anyone who didn't own a home during that window, the door slammed shut. By 2022, the Federal Reserve began aggressively raising rates to combat inflation. By 2025, mortgage rates sit above 6%, and in some weeks, they've touched 7%. The average mortgage payment has jumped 113% since 2020. That's not a gradual increase. That's a financial earthquake. Here's the compounding nightmare. Home prices didn't fall when rates rose. They stayed elevated because inventory remained choked and demand, while weakened, still outpaced supply in most markets. So new buyers face a double squeeze. They're paying peak prices with the worst financing terms in 15 years. A home that cost $400,000 at 3% interest now costs $420,000 at 7%. The difference in monthly payment is staggering. Over $1,000 more per month. Over $12,000 more per year. Over $360,000 more over the life of a 30-year mortgage. Meanwhile, homeowners with low rates aren't selling. Why would they? According to Redfin, new listings rose just 0.9% in late 2025, the smallest uptick in months. Many would-be sellers are staying put because moving would mean giving up their cheap mortgage and taking on a vastly more expensive one. That's the lock-in effect, and it's freezing the market in place. Inventory that should be circulating and creating opportunity is instead trapped behind cheap debt. The entire system has seized up, and no one knows when or if it will unlock. Older Americans are wealthier than any previous generation at the same age. People over 70 are now over 70% wealthier than the same age group 40 years ago. Meanwhile, people under 40 are 24% less wealthy than their counterparts 4 decades ago. That's not a gap. That's a chasm. And it's widening every year. Older Americans now hold 52% of all U.S. real estate wealth. That's more than every younger generation combined. Here's what that means. A massive wave of housing wealth is concentrated in the hands of people who bought when homes were cheap, wages were rising, and the economy rewarded savers. Much of that wealth will eventually transfer to their children through inheritance. But those children are already disproportionately in the upper half of the wealth distribution. If you were born into a family that owns property, you'll likely inherit property. If you weren't, you're starting from zero in a market where zero means you've already lost. This creates a self-reinforcing cycle. Wealth begets wealth. Property begets property. And the gap between those inside the system and those outside it becomes permanent. According to Harvard's research, the homeownership rate fell in 2024 for the first time in 8 years, dropping to 65.6%, and then spiraling further to 65.1% by early 2025. The largest decline occurred among households under 35, the demographic that has historically driven first-time buyer demand. What we're watching isn't just a housing crisis, it's the calcification of a class system. When the primary vehicle for wealth creation, home ownership, becomes inaccessible to 70% of the population, you don't have a meritocracy anymore. You have a caste structure. And when people don't own anything, they don't feel invested in anything. Because they're not. That's not a stable society. That's a society on the brink. Even if you can afford the down payment and stomach the mortgage rate, there's another financial predator lurking in the shadows: insurance. In states like Florida, California, and Arizona, homeowners' insurance premiums have exploded beyond recognition. In Florida alone, average premiums have surged over 60% since 2022. In Cape Coral, flood-prone properties now face annual insurance costs between $8,000 and $12,000. Some major carriers have pulled out of the state entirely, leaving homeowners scrambling for coverage through high-risk state-backed pools that cost even more. California's wildfire zones face the same nightmare. Communities like Santa Barbara, Malibu, and parts of the Sierra foothills are seeing premiums double or triple. Some hillside homes are being denied coverage altogether. Phoenix isn't immune either. Desert heat and drought conditions have pushed rates up 40% in just 3 years. For buyers, this creates a brutal squeeze. Mortgage payments are already stretched by 7% interest rates. Now add $500 to $1,000 per month just for insurance. That's pricing middle-class families out completely. Property taxes are climbing too. HOA fees in some developments have become exorbitant, with assessments reaching $30,000 or more just to connect to municipal water and sewer. These hidden costs don't show up in the listing price. But they're real, and they're crushing people who thought they were making safe investments. The insurance crisis isn't temporary. It's structural, driven by climate change, actuarial reality, and the refusal of private markets to absorb catastrophic risk. And it's fundamentally reshaping which markets remain viable for home ownership at all. If you thought the down payment was the hard part, wait until you see what it actually costs to keep the house. For many families, the math simply doesn't work anymore. Not even close. The 2025 housing collapse is not a prediction. It's a documented reality unfolding in real time. This isn't 2008, where a bubble inflated and popped. This is a systematic lockout, engineered through money printing, policy failure, wage suppression, corporate consolidation, and interest rate manipulation. From coast to coast, the warning signs are flashing red. Affordability has cratered to the worst levels in over 40 years. First-time buyers have been priced out entirely. Institutional investors control more of the market than ever before, and an entire generation now believes the American dream is dead. But here's the critical truth they don't want you to understand. This system was designed to make it nearly impossible for outsiders to get in. It rewards those who already own assets and punishes those still trying to save. The game is rigged, but that doesn't mean you can't win. It means you need to play smarter. You need to think like a capital allocator, not a renter. Get into entry-level assets through house hacking, co-buying, or fractional ownership. Position yourself for distressed opportunities when the next wave of panic hits. Diversify into a sensible basket of uncorrelated assets. And most importantly, stop waiting for permission or perfect conditions. They're never coming. Knowledge is your greatest asset in a rigged market. Armed with the data we've covered today, you can make strategic decisions that protect your future instead of hoping the system fixes itself, because it won't. Not without massive political will and structural reform. And that takes time we don't have. So if this breakdown opened your eyes to what's really happening, smash that like button right now. Subscribe to Housing Intel for weekly data-driven real estate intelligence that exposes the truth Wall Street and Washington don't want you to see. Ring that notification bell so you never miss an update, and drop a comment below. Which factor shocked you the most? Are you buying, selling, or waiting? We read every single comment. We'll see you in the next video. Because in a market this broken, knowing where not to invest might be the smartest financial decision you'll ever make.